Welcome to The Explainer. Today, we're diving into, well, kind of a massive paradox. Think about it. How does a tech titan completely smash its earnings records, only to watch its stock violently plummet? And how is this sudden whiplash directly tied to a massive, slightly under-the-radar shift in macroeconomic policy? Let's get right into it. Okay, let's dive into this. It's a scenario that honestly defies basic investing logic. Broadcom just reported an absolutely stellar Q2. I mean, they crushed their targets, and their AI chip sales exploded by 143%. It's huge. Yet, the market responded with a massive sell-off, literally wiping out $300 billion in market cap. So what exactly happened here? Now, to understand the crash, you really have to look at the climb. Going into this Q2 report, Broadcom stock had already surged a massive 55% in just one quarter. Investor expectations weren't just high, they were priced for absolute flawless perfection. There was zero room for error. And you know what? The actual results, they weren't in error at all. They were rock solid. Revenue hit $22.19 billion, easily beating Wall Street estimates. Earnings per share topped expectations at $2.44. They even maintained a 69% EBITDA margin. Now, what's really crucial to understand about this is that a margin that high essentially means the core engine of their business is incredibly profitable and fundamentally sound. But then came the whiplash. The second the market opened the very next trading day, bam, Broadcom shares plummeted 13%. Nearly $300 billion vanished overnight. So if the numbers were that great, why the violent drop? Well, it all comes down to a few hidden factors. Factor number 1, AI expectations versus reality. Here's the deal. Broadcom projected their Q3 AI chip sales would hit $16 billion. Now, in the real world, a 200% year-over-year jump, that is explosive growth by any normal metric. But Wall Street, they had penciled in a staggering $17.2 billion. Missing that astronomically high, almost impossible expectation was the very first trigger for the sell-off. This whole situation really exposed a massive rift between management and investors. Broadcom CEO Hock Tan actually put it bluntly. He said, "We're not trying to guide you every quarter on what 2027 would be like." So the crucial takeaway here is that management is playing the long game while Wall Street just has zero patience and demands blockbuster numbers today. Moving on to factor number 2, Alphabet diversification revenue risks. So while Broadcom did extend its partnership to build custom AI chips, those TPUs, for Google's parent company Alphabet, management had to admit a pretty hard truth. Alphabet is bringing in competitors, like MediaTek, as a secondary source. Broadcom is actively losing its absolute monopoly with a mega client, and the market immediately priced in that long-term risk. But this actually builds into an even bigger problem, because there is a third factor at play. Welcome to the new Fed reality. To really understand this volatility multiplier, we have to zoom out and look at the broader economy. We just got a red-hot jobs report, 172,000 new jobs added in May, with unemployment sitting at a very low 4.3%. Now, for tech investors, a strong economy ironically means bad news. Why? Because it completely dashes any hopes for imminent interest rate cuts. High rates make borrowing expensive, which directly hurts high-growth tech valuations. And all of this economic heat? It's colliding head-on with a massive regime change at the Federal Reserve. After a super tight 54-45 Senate confirmation vote, Kevin Warsh was sworn in as the 17th Fed chair in May 2026. And let me tell you, he is bringing a radically different approach to the job than his predecessor, Jerome Powell. Which leads us to our next major shift, the death of forward guidance. For years now, Wall Street has basically treated the dot plot like gospel. It's a quarterly chart where Fed members literally project where future interest rates are headed. It acted as a safety net, right? An economic cheat sheet, letting investors predict the future. But Chairman Warsh believes this creates a false sense of precision, and he is planning to kill the dot plot entirely starting this June. So we're officially moving from this era of high transparency and, let's be honest, hand-holding, straight into the Warsh era. We're talking leaner balance sheets and absolutely zero hints about the future. And this brilliantly illustrates the core problem. Politicians might actually love this quiet approach, with headline inflation hovering at 4%. But for investors, suddenly ripping away the roadmap basically guarantees massive volatility in tech stocks like Broadcom.
So, navigating tech stock volatility.
All right, so how do you actually handle this? First up, you've got to prepare for some wild swings in borrowing costs. It's gonna happen. Second, zoom out and focus on the underlying growth. Yes, Broadcom missed the crazy AI hype targets, but their Q3 revenue is still projected to grow by 84%. That is phenomenal fundamental strength. And finally, avoid panic selling just because the Fed isn't holding your hand with forward guidance anymore.
Because as we enter this completely new market, one without a Fed safety net or a dot plot to guide us, you have to ask yourself a really hard question about your own portfolio. Are you invested in the hype, or are you invested in the fundamentals? Thanks so much for watching this explainer, and we will see you next time.